Okay, great. Just wait for Andrew to get back to the room as well. So this talk essentially follows on quite nicely from what Brett was just talking about, setting the scene. I'm not entirely sure how long it's going to be. This is the first time I've given this exact talk, but if we want another break in the middle, if anyone's sort of waning a bit and wants another coffee, just let us know. And so what the purpose really is to introduce the interdependence bond and provide a bit more context to explain what actually is it and where did some of the thinking come from. I mentioned yesterday maybe not waiting for things to be 100% before putting them out there, mainly because of the urgency of the climate situation that we're in. So there are a few details that we're in the process of still refining with the members of the Treasury, and so Pierre, who's one of the trustees, he's going to be giving a talk in about 10 days' time, and some of the more mathematical components I'm going to leave to him to talk about then, as I'm not actually a maths person, I'm a bit more of a sort of strategy person. But yeah, we'll see how it goes. And if you do have any questions as we go, let me know. So I guess first of all, I just want to really start off with this idea of, or question, what is money? And for those of you who applied to volunteer, you'll have seen that was a question that we asked everybody, really to get you thinking, what is this thing that we use every day? And to some extent, we're born into a situation where we don't really have much choice about what it actually looks like. So there's a great book by David Graeber, certainly a very learned fellow, looking at the history of money. So it's called the first 5,000 years of debt. And I definitely recommend checking that out. I can actually just hear a bit of feedback on that end, maybe. Do you want to just turn the volume down a little bit? Thanks. So yeah, that's just if you're wanting to have a good overview of money, where it's come from, it's definitely a book I would recommend. And one of the things that I think is just sort of interesting is to think about the origins and how we used to have essentially ledgers that were in this case, money sticks, so often on a piece of wood where people would mark a unit of account. So, it might have been, well, last week you gave me 3 chickens, okay, we'll etch that on. This week I'm giving you, I don't know, some corn or whatever it is that you're trading. And really just sort of thinking, well, actually that's sort of where it came from. It was very much a ledger in that sense. So we might talk about something like a blockchain is ultimately a multi-distributed ledger. That's its sort of more appropriate name. So just good to think about the origins. And you can see from other places in the world, this is from Papua New Guinea, they're using shells as a sort of form of token. Many of you might have heard the song or elsewhere, but money is the root of all evil. I was actually sort of looking up where did that quote come from. Turns out it was in the Bible. Money's sort of for a long time been something that people have discussed and thought about whether or not it's doing good or harm. Certainly, if we look at usury, I think it was Aristotle who originally sort of defined usury really as any money made from a loan. And if you look across numerous of the major religions, there have been periods of time where usury was outlawed. And so, and today in Sharia finance, in the Islamic world, you can't actually charge interest. They do have other ways of transacting where you're sort of almost like getting a fee for doing something, but it's not interest. And I think that's a really interesting point that throughout seemingly quite large parts of human history, we've deemed interest to be immoral. And yet, as we'll talk about in a moment, it would appear that money, we have a lot of interest going on in our money system today. So does that mean it's moral, or perhaps not? So what is money? Well, there's probably this might not be exhaustive list of terms, but when I think about money, certainly top 3, a store of value. So you would hope that when you look at your bank account, it's more or less the same value as when you last looked at it, notwithstanding any transactions going in or out. A unit of account, so that sort of goes back to the original form. We use it to make transactions easier. If I have 3 chickens and you have some some corn, it might not be quite so easy to transact, but if we're all using the same system of account, that's certainly helpful. And then ultimately as a medium of exchange, so a way that we can transact and function in that anonymous, large-scale society that Brett was talking about earlier, which obviously is what we have today. Okay, so moving on then, does our existing money system work for us? So I think one of the things that certainly been thinking a lot about over the last few years, particularly after reading Yuval Harari's book, Sapiens, how ultimately one of the things that humans have done throughout history, and indeed it's the way we've managed to organise ourselves, is by telling ourselves stories and creating these fictions that we then use to organise. So, for example, we talk about legal entities that are in a legal system that has been dreamt up by humans collaboratively and evolved, in layers over the years. The money system is no different. It's something that we have dreamt up as humans, and we use it now to do various things. Or, as we'll see in a moment, does it use us? Maybe another way of thinking about it. So we talked a little bit about this the other day, and I've tried to find a slightly better diagram from the talk on Monday. But fractional reserve banking, very interesting phenomena that maybe not everyone is always familiar with. When a deposit goes into a bank, this is typically across, I believe, most of the Western world, it's a sort of capital ratio of about 10 to 1. 10% of the money has to be kept in reserve, which is, in case everyone wants to take the money out, there has to be something left in the bank. But then, up to 10 times that reserve amount can be loaned out. And if you think about this as a sort of trickling down diagram, that can be repeated over and over again if someone's taking that loan out and putting it in a new bank. And so what you end up with is essentially, particularly if it's being loaned out, more and more debt being created in the system, but also an increasing money supply more generally. And as I mentioned again on Monday, that is being done by private banks. And if you or I started creating new money, we'd be put in prison, which is an interesting fact to note. So they are private entities. So this is an interesting organisation, Positive Money, that do a lot of work on this. And they've handily collected some data to say, well, that's interesting, how much money have banks created? So often when we think about money, we think about physical cash, which is minted by, I think it's some sort of minting agency. But then we also have, and that can also be inflated by things like quantitative easing, which is a posh word for printing more money. But if we look at this here, we can see that there's been a considerable inflation in the amount of money in the system just over a relatively short period of time. Interesting to note, again, that seems to be in line with the departure from the gold standard as well. So cash, 3%, money created by banks, 97%. That's quite.
Can you elaborate exactly what you mean by money created by banks? By money you don't mean physical, right?
Yeah, it's digital money.
Okay.
So effectively written into existence by, if I issue you a loan as a bank, then I've put, let's say, £1,000 into your account, and then most likely in today's economy, you're not going to take all of that out in cash.
Promises issued by banks.
Yes, a promise. Yeah.
There's nuances.
So if people want to take their money out in cash, they'll only be able to 3%.
That is a.
Just to make a point, it's not actually necessarily, not to throw spanners in the works, it's not really cash per se, it's state money. Cash is a physical implementation of state money. You can implement exactly the same thing in a digital form, which they call reserves, which is what banks have. So what we're talking about is cash is how we experience state money.
What about gold?
That's not part of the system. So the distinction is state money versus bank-issued promises for state money, which is what we call deposits. It's the red section.
But yeah, there is definitely a pretty well established phenomenon that if everyone tried to take their money out of the banks at the same time, a run on the banks, there would be a problem. Cash machines in themselves don't have enough money to handle that. Yeah. Okay, so then the question is that money, all this money that's being created, is that being used to create a sustainable, a sustainable system? So we can see here, this is taken, I think it's data from Bank of England and some others, but so the vast majority of this money is going into mortgages, loans, so again, effectively more debt, and then also the financial sector. So there's definitely a sort of idea, that we've kind of have a financialization of our society, and particularly acute here in London, where it's often talked about that if the financial sector goes, the whole economy goes. Well, see what happens after Brexit. But so the it would appear that this money that is coming into existence is mainly fueling further lending, and then public sector, so education, schools, hospitals, all that sort of stuff, is only around 2.2%. So it's not. We can't exactly say that all this money is coming into existence and building, I would argue, the sort of society that we would perhaps like to see. And we've obviously had major issues in terms of housing bubbles, price collapses. I mean, if you think about the 2008 financial crash, which was largely fueled by toxic loans into real estate in America, but elsewhere, it has to be asked whether or not it is helpful to have an economy that is giving away cheap credit to buy things that maybe we can't afford, or maybe we don't even perhaps need. So the other thing that's kind of interesting when you think about money, and particularly in the context of let's say crypto, things like Bitcoin, where we'll come on to this in a moment, but where the supply is predetermined, the money supply in terms of money that is being issued by central banks is we've seen how private banks are creating money, putting more of it into existence, but then also a central bank, through things like quantitative easing, can increase the money supply as well. And so, I would say the main constant I definitely agree with in the world of economics is this sort of idea that supply and demand converge somewhere and you have a price or a value. If you increase the supply, typically the price will go down. And so what this really means is that when more and more money is being created, it is devaluing the money that all of us are holding today, or at whatever point in time we're talking about. So this is the US, pretty much the last 100 years. These are cumulative numbers, but as you can see, it's gone up pretty significantly. This is then looking at the UK, goes back even further. Obviously, we've seen some spikes when there have been various wars. Someone's asking what happened here. Yeah, that's an interesting question. Yeah, certainly, and one of the things when you're managing an investment portfolio, you're always trying to beat inflation just to essentially keep your head above water. So if inflation is running at 1 or 2% a year and your returns are less than that, you're actually losing money in real terms. So inflation is always whittling down whatever we've got in our bank accounts, unless they are increasing at a greater rate than inflation. And that's why we often talk about things like wages in real terms or inflation adjusted. So I guess my sort of question here is that sustainable, and is that working for us?
You have to also. That's a big debate.
Okay. So
I suppose just to throw something in, when thinking about money systems, it's very important to not only think about the monetary leg. Money is like one half of any economic interaction. There's always two sides. So while this is true, you simultaneously have to look at what's being produced in an economy. And that gives you the bigger picture. So it is true, for example, that if you worked in 1910 and then cryogenically froze yourself for 80 years and then woke up again in 1990, the money that you had would not be worth anything. But in the meantime, a dynamic economy has continued to exist with people producing things and stuff. So you've got to see how the interaction between the money layer and the production layer is going on. But in principle, what you're saying is
do you mean things like, for example, if technology prices have come down and it costs you less to buy, I don't know, like an iPhone than it did? It's maybe a bad example, but a computer, let's say.
Yeah, it depends on what position you're putting yourself in. Yeah, so if you were a person who somehow froze yourself and for 100 years didn't do anything and then woke up again with your money units, you would discover that the society around you has changed completely, and your money units now can't do what they previously did. But the question you want to ask is we live in a dynamic network economy where the tokens are interacting with labor networks. So you've got to be careful when thinking about these inflation figures about how they interact with the underlying labor networks and dynamism that's going on, because they're not like static objects that should be static in a sense. So that's the main, but not to disagree with the point that banks have been inflating assets and doing all this kind of stuff, which is true.
I mean, you could put a chart here that's looking at purchasing power, which might be a slightly more accurate reflection of that, what you're just saying there. Okay, so let's just move on then to some video watched recently. It was a talk given by several members of the Union of Concerned Scientists to the European Commission, talking about climate resilience. I recommend giving it a watch. And I'm just going to sort of pull a few quotes here from Stuart Scott. Essentially talking about how global civilization has an operating system, which I certainly relate to that. I think it's a good way of thinking about it. And he's saying it's seriously flawed, which makes sense when you think about some of the things we've been discussing about how sustainable it might be. And what he's saying is that actually when we think about this operating system, it really has two names, money and economics. But when he mentions these terms, he's certainly very careful to define them as the particular type of economics and monetary system that we have, which is today most pervasive, and that's neoclassical economics, or neoliberal, depending on the time. And what he says is that uses the term meme in the sense, not necessarily like the internet meme, but something that is almost passes from generation to generation, from society to society. We're born into it, and he likens money to being like a virus of the mind, where the money system is using essentially humanity for its own reproduction, and it's ultimately turning the natural world into more money as fast as it can. And if you look at, for example, what's happening in Brazil at the moment, where they're trying to sell off the rainforest as fast as they can to turn it into money, you have to say that that is a pretty accurate description of what's going on. And that's where some of these critiques of things like natural capital come from, as a term that might not be particularly helpful. So I guess my main point here is, what if we turned it around from money being the root of all evil to actually think about using it to build a better world rather than destroying the existing one? So, before we go into more about the interdependence bond, I want to talk a bit about what I would consider to be sort of cryptocurrency 1.0, or the first iteration, and that sort of came out of the likes of Bitcoin. So Brett talked about that before. I'd say at quite a sort of high level. I'm going to kind of maybe go to the medium level detail here. So a few things that initially attracted me to the idea of cryptocurrency or Bitcoin got me thinking. So the first one, the fact that it's decentralized. So the idea that instead of a central bank being able to change the rules of the game effectively by printing more money. I know that they're generally trying to balance inflation in a way that makes sense. The idea that something is decentralized, or to some extent, we talked about that in the last session, almost hard-coded. The rules are hard-coded, you know what it is you're getting into. I think that's quite an interesting idea. So I'd say that's a pro in favour of something like Bitcoin. Then there's this, effectively, the inflation, or the amount of the issuance of the tokens is predetermined at the start of the game, if you like, and not taking into account the fact that it might, they might launch another version where they print more. If it stays true to its original conception, you've effectively got a limited supply that is predefined, and you know what that is, which is very different from a system where the supply might be increasing over time, which is kind of what we have today as per that previous chart. And so the idea here is that you've effectively got an increasing supply, but it's decreasing in terms of speed over time. So that's what's going on there.
Sorry,
yeah, sure.
I don't want to disrupt your webcast. Just to note that in this community there is a linguistic problem, a battle that occurs. This term inflation here actually in a lot of crypto world means money supply. So there's a distinction between people talk about inflating the money supply, which means increasing it. Whereas in some forms of economics, inflation isn't that. Inflation is a change in the power of a token to command real things. That's different to how many tokens you issue. And so this would be like the money supply of Bitcoin the token supply is fixed, which in some economies would be that's not the same as inflation. That's the supply, and then the actual power of those tokens will depend on how it's interacting with the underlying. If that makes sense. So just make me aware that there's a distinction between the language of
Maybe a better way to. I think I tried to sort of say that, but it's the number of bitcoins is inflating gradually.
Increasing.
Yeah.
The supply has a constant, and then you can debate if it was me, I'd say the inflation is a separate concept, but I accept that it's. I don't know what it's.
All right. I guess the key point here is there's a limited supply over time that has been predetermined. That's the point of this chart. Okay. So and that very much contrasts to fiat currency and money, where we see that essentially going the other way. So that I certainly think is an interesting concept. So I'd give that a pro in that case, if you're looking to have something that potentially increases in value over time, if the demand for it increases. So that's kind of the whole theory. So it's digital, which I would argue is something that can either be viewed as a pro or as a con. I know, Brett, you talk a lot about cash and cashless society, and we do have to perhaps ask ourselves whether or not having the ability to transact anonymously is actually a healthy thing to be able to do in society. Maybe there's a question around who is it that's monitoring all of those transactions. But if you have a company, if you think about with your mobile phone today, if you're using something like Apple Pay, the amount of data these companies have on us is pretty terrifying, really. Should it ever fall into the wrong hands, or or perhaps it's already in the wrong hands. It's so then there's the issue that we talked about this earlier in terms of this exponentially increasing computing power required to mine new coins and solve those problems. So those mazes that are being run through are getting harder and harder to run through, and that has a major problem. Which is ultimately that it's using up a crazy amount of energy. There's been some studies that are suggesting it's been using up as much energy as a long list of countries. I think the largest one it got up to was Denmark. Obviously, it's going to depend exactly how you do the calculations, but the point is it's using up a lot of energy. Now, if you're trying to design something that's maybe trying to tackle the climate crisis, having ridiculous amounts of energy use is not very sensible. And I would suggest that whoever designed it maybe just wasn't really thinking about that particular issue very clearly, because anyone who spent a little bit of time on it might have thought that wasn't a great idea. So yeah, going to say that's a definite bad idea. It's not backed by anything. Now, maybe the tension between commodity theory and credit theory, maybe it doesn't need to be backed by something in order to function. So we have, in terms of a commodity, we have a fiat money system today that's essentially endorsed by the government. We can use money as legal tender, but we've done away with that previous system of it being backed by gold. In the case of Bitcoin, it's not backed by any physical real-world thing, and I would argue that's why. So I'd say it's not a particularly helpful thing, because I'd argue it's one of the reasons why you end up with high volatility. So the price going up and down, like this all the time. And I think that makes it very difficult if you're trying to have something that you can use as a unit of an account or as a medium of exchange. If I go to buy a coffee and by the time I've walked back, the price is cut in half, that's just not very practical. So it does potentially make sense as a store of value if you do think it's going to go up over time, but it's not really very usable as a currency. So I would argue that's a con against that. And then we talked a little bit earlier about transaction fees. So this is the chart showing the spike that I think you were referring to earlier. Obviously, if you think about something like PayPal or all of these credit card processing, we're kind of used to the idea of transaction fees. Maybe we're willing to tolerate 3.5% or whatever it might be. But clearly, if you get up to crazy numbers like over 100% of the transaction you're trying to make, you just don't have an incentive to even transact. So that's going to reduce the ability to use it as a liquid transaction tool.
Sorry, why did this happen? This massive spike?
Brett, you might have a better answer than me. But it looks like it's when the price went super high.
Yeah. Just it'll take 2 months.
Okay.
It was roulette. There
That's a hell of a spike.
there was a huge backlog of transactions, and guys would start to act as if they were sort of
Oh, really?
kind of like
Was there like a rush to get your money out or something? And they were saying.
Imagine like a highway that's really clogged up.
Yeah.
In that situation, they can start to raise fees.
Somebody has a road to get off the highway.
If
but they
So
say,
they'll be
well,
like,
if you
yeah,
want-
I will only do it if you like this.
Interesting.
I guess that's a good example of maybe the system not working so well if you've almost got a cartel of people that are in the position to do those transactions. So I'd argue that, again, that's a point that's not in its favour. So then we also look at the last, let's say, and most key point is the actual price. So I don't know if you've seen this before, it's sort of looking at the all-time history. So for a very long time it was pretty much nowhere, and then all of a sudden we sort of saw this rise and then a spike and then a kind of crash, and now we're back onto an upward trend again. Again, that makes it very difficult if you're trying to actually use it as money to transact. So I'd say that's another point against Bitcoin.
This is the value of one Bitcoin.
Yes, it is. Yeah, and you can see the market cap there at the bottom. So it's pretty high. But ultimately, a point that you could argue is in its favour, and that's an interesting element or characteristic, is that the price has increased over time, which typically one would think in a system where the supply is constantly enlarging with fiat money, that's typically not going to be the case. So that's, I'd say, where you see something more interesting. And that I'd say is something in its favour. So all of this, I would say, was kind of thinking about maybe crypto 1.0. That was an interesting concept. But as so often you see, a little bit like with the internet, some people came up with an innovation, they iterated, and perhaps now there's the opportunity, and this is what we see, for the next wave to come through. what we sort of have to hope is that there isn't too much negative press associated with perhaps that first iteration, such that the baby gets thrown out with the bathwater with version 2.0. And that, by the way, is why we originally were calling this interdependence coin, and we had such horrific backlash from some people that we mentioned the word coin to, that we renamed it interdependence bond, and we'll talk a bit more about that later. But we mentioned framing this week. If somebody has a negative connotation with something and you almost trigger them by just saying a word, if there is the opportunity to avoid that negative association and triggering, sometimes that could be helpful, and that's part of where that strategic decision came from. So if we were thinking about creating that 2.0 version, then what would we want it to look like? What characteristics could be interesting? So I would argue that either having something that is steady state, so there's this term stable coin for coins that are flat in terms of value over time, typically pegged to something stable. That could be one utility. But then you lose the incentive for people to be early adopters. And I think that was one of the things I always thought was really interesting with Bitcoin, is that so you had all these, if we just go back to this chart for a second, we had all these people at the beginning who were able to access this coin very cheaply for many years. And if they foresaw what might happen here, which a lot of them did, and there were a whole bunch of sort of crypto millionaires and even a few billionaires that popped out of that bubble, they all had an incentive to go and sell it and to go and tell everyone how great it was and to whip up a hype. And you might have seen a few people like the Winklevoss twins, a guy called Max Kaiser, who's really firing everyone up, saying this is the next big thing. And if you own 30% of the supply, well, it's in your self-interest to do that. And in this case, maybe it sort of didn't have the substance to it to really warrant that. But I think that's an interesting characteristic to incentivize early adopters to participate in something, because they'll be rewarded later if it grows. So the idea that actually maybe it doesn't have to be crazy returns, but actually if it has a way of increasing steadily over time, I say that's definitely better than it decreasing in value over time. I don't know if you ever tried to sell anything, but if it's going down in value, it's harder to sell. If it's going up, it's probably easier. So that would be a nice characteristic to have. Low volatility, it's pretty obvious you don't want something that's sort of going crazy. Something more stable would be good. I think if you're trying to do anything in the environment space, but particularly relating to energy or climate change, you can't have something that's using up crazy amounts of energy. And particularly, I think one thing that's always really important to think about whenever you're doing anything, but it's what if we were wildly successful? If we get to the end of the roadmap, the plan, if we're using up more energy than the sun, that's clearly unsustainable. So it has to be low energy. And what about if we actually could use it for something good? What is Bitcoin actually doing, apart from using up lots of energy? Yes, there's some interesting ideas in there, certainly conceptually. We talked about decentralization, for example, cooperation, people working together. But is it building a better world by virtue of its existence? So I guess this is for Crypto 2.0, the idea that it could actually be used for good and to reverse that trend of money being thought about as an evil. This is just the last section then. So this is basically explaining the interdependence bond and just making sure we've sort of got a conceptual overview of what it is. So some of the stuff we went through on Monday, but sometimes going over it again as it's a new concept could be useful. Okay, so first of all, somebody makes a donation, which would be in pounds or euros or whatever currency that will be. That goes to the interdependence treasury that's been specifically set up to be the custodian and manager of funds received from donations. That's really its only purpose. In exchange, the supporter receives interdependence bonds back. So the interdependence network that we're building, the digital community platform, each individual will have an account, and within that account they'd also have a wallet. So a little bit like you might have a Bitcoin wallet that sort of lives somewhere. The idea is that people's wallets live within that platform.
Sorry, can I ask, like, why call it a donation? It's like a purchase.
Very good question. So the maybe I'll come back onto that in a moment in more detail, but just to touch on it. So you can either, so from a legal perspective, it is a donation in that somebody is donating money to the interdependence project, and in return they are getting effectively a digital receipt, which is saying, you know, thank you very much, and that digital receipt is effectively a token that entitles them to a set of things. But one of the things is that they cannot redeem their token with the interdependence treasury for money. So in other words, they can't take their money back out. What they do have, though, is something that, if this project succeeds, and we hope it will, that has value. So in effect, it's different from, so it has characteristics of an investment. It's almost a hybrid between a donation. So if you've got donation and investment over here, it's like a hybrid in the middle.
Would it be nominal or transferable?
What do you mean by nominal?
It's like buy a bond at the bank, is it to your name, you can transfer?
Oh yeah, so it would be transferable, yes. So you, yeah.
Between members only, or between also someone which is not a member?
So it will be transfer.
So the project, because the fact that you buy a bond, it automatically adds you as member, isn't it?
So the only place that the bonds will live digitally is within this interdependence network platform, and so the does that sound okay? Yeah, let's try to thought there. So yeah, effectively they do have to be a member in that they have to create an account and they have to register. But you can transact it with any other individual that will, you know, receive your bonds.
So you can trade it.
Yeah, effectively you can transfer them, use them as a medium of exchange.
Between members, yeah?
So if I wanted to send, if I've got 100 bonds and I want to transfer them to you, I can do that.
But can I buy them from you?
That's between effectively, you know, you and I to decide that if you want to. But we are not at this point in time. We're not becoming an exchange per se.
So I'd have to privately just send it to you and then privately message say, okay, I'm going to give you 100 quid for these bonds. Like they could, like how people used to do FIFA cards on eBay. Like, couldn't that change the value wildly of them if there was like people privately trading them for currency?
So we'll kind of come on to that a bit in a moment, but if something has a, I guess it's the point of like arbitrage in the market. So if you have, okay, an example would be if you have like one of these cryptocurrency exchanges, and there's, do you mind just turn the volume down a bit so I can just hear it? There's a price of say 100 on all of the exchanges apart from one where it's 110, then what will happen is people that sort of specialise in arbitrage, or just anyone who notices that, will effectively see that there's an opportunity and they'll start transacting and they'll kind of bid the price back into almost like into where it's supposed to be. And that's kind of sort of the idea of like efficient markets kind of generally do that. So I guess that the theory would be, as we are always going to be issuing these bonds at what we would, in as transparent a way as possible, can consider to be the fair market price. If you know someone's trying to sell them to you for double, why don't you just come to us?
Yeah.
And therefore, so what we would expect to happen is people potentially trading them slightly below that price or at the price, but not wildly above it. I mean, it could theoretically happen, but it wouldn't make logical sense.
Yeah.
So
yeah, sure.
You said you could theoretically, if you were in the market, that would be the case with someone is trying to buy someone else's company, you buy shares as until you reach threshold, you start dictating to the other party what you want to do because you got most of the shares. Would be the same case if somebody is not secret, but starting to buy the bond from all the people and then come to you or whatever to the head of this group saying, I've got all your bond in my hand, I own the all now. You're forced
To do what?
to do something that he requires.
Well,
Yeah, well,
In terms
so
of steering the company toward the different policies, for example.
Well, they don't have a voting right attached to the bonds, but I suppose could they threaten to ask for everything back at the
no.
same
So
time?
that's the thing. Because so the key thing, and there's a diagram a bit further in the slides, but is that unlike a traditional, how most people think of a bond, or an investment in any fund, typically you can redeem your shares. I mean, it depends how liquid the thing is. Sometimes you have funds where you can't take your money out for a period of time or whatever it is. But in this case, because it is effectively a donation, it's like once you've given your money to Greenpeace or WWF, you can't get it back. That's the point here. So even if someone owns all of the bonds in the world, they don't really have any particular power over us other than being eligible for essentially the contractual rights, which might be to buy energy.
Right.
Yeah.
But you wouldn't be promising to deliver that energy all at the same time or anything like that. So
Yeah, I mean, I don't.
You wouldn't be promising to do anything you weren't able to do. I guess.
That is actually very interesting because if you have, for example, nowadays we were looking at this a few days ago, major investment like solar panel, blah blah blah, goes only most of the money goes in big project. Yeah, it's very difficult to make a local community self-reliable, make a company because nobody is interested in small projects. But it's interesting in the sense that if you have an entire local community coming together, founding percent of the project, and then you will find other people, then it goes back to the fact that they can then get they have the structure, the logistic, area, plus they got the benefit of the cheaper energy plus. But it means that producers of solar panel or engineering company, people that engineer these plants, will look at you in a favorable way because this guy perhaps has got 200 people who will invest in this plant ahead, on the blueprint.
Yeah, I mean that's the idea. Is to by virtue of making that donation and receiving back a token, you might not have a form of ownership in the traditional sense where you can take your money out and get dividends or have voting rights, but you can use it to participate in that community and reap the rewards of the energy or the food and effectively feel part of an ownership, a bond. I mean, that's partly where we decided to use the word bond, to be bonded with that community. There's a tie there. I'm going to keep going because I feel like some of these questions that you're asking might get answered as we go. So part of the logic here is to use the money that comes in from donations, which we expect to be smaller than perhaps what might come in from institutional investors, to get co-investment. So using similar sort of case studies, a bit like think about a deposit for a house. If you've got 5 or 10%, you can potentially leverage that to get crowdfund, if you like, from institutional investors to go a lot faster. And so that money, once it's been collected, effectively would be used to build sustainable infrastructure. And then at the end, the bond holder, effectively just as a pound coin might say, entitles, or you've got a promise to pay the bearer the sum of £10. We're saying we promise to let you use that bond to be exchanged for the energy that has been produced from using that donation in the first place. So makes a donation, get a bond back, co-investment from institutional investors, gets invested, and then it can be used at the end for the purchase of food and energy. So the idea being that this bond in it is effectively backed by a basket of assets that are held by that treasury. And so we'll go over this another couple of times, but effectively at any one time, the value of the bond is a function of how many bonds are out there and the value of the assets held. And if those assets are actually generating a yield, so for example, if you're selling food that's produced locally, or you're selling the energy, not at extortionate prices, but at a rate that means you're getting almost like an interest or a yield, a return on that initial capital, the principal, if you think about it, there's the opportunity for it to increase in value over time. So when I showed that chart earlier of, we don't want something going like this, but actually if it has the potential to increase in value over time, then that's a more attractive proposition than if it goes down. So that's some of the thinking there. And we used to have a gold standard, we don't anymore, but this in a way is trying to think, or almost like to hark back to that and say, well, can we be using a form of money or currency, or however you want to think about it, that is actually backed by something tangible and real? And as gold can be used, but it's not something that can feed you or provide energy, and so potentially it's more useful to actually be able to redeem it for those things, particularly in a climate-ravaged world where the financial system may not be particularly resilient to various shocks that may occur, and where those basic needs, food, energy, shelter, are going to be pretty key. So it's sort of like a bit of a hedge against the, when thinking about investments and a diversified portfolio, you often want something that's not correlated. So let's say that you think that, in fact, gold's a good example. So if the stock market is going up, sometimes that can mean that gold's going down, or maybe not so much. And equally, often in times where the stock market crashes, people tend to sort of fly to or flock to safe havens of assets that are considered safe in periods of market turmoil. So this can be viewed as something that could be a hedge against the collapse of essentially the existing monetary system, and that also provides a tangible output, i.e. local energy, sustainably produced food, all that sort of stuff.
So, just really quick,
Sure.
Do the institutional investors also get bonds?
So what we're essentially looking to do is structure funds where the interdependent treasury is taking a stake in those funds, and helping to establish the investment principles for those funds to be sort of interdependence funds. And although institutional investors will have the opportunity to buy into the bonds component, that is probably a little bit of a too radical step from where they are today. And so we would expect most of them to invest along more traditional lines and own shares with fiat capital, just as essentially the Interdependence Agency would use the fiat capital it received from donations to also own shares.
So no, they don't get bonds.
They can if they want, but we expect them to buy shares in these funds to co-invest.
So they have the choice.
They have the choice, just as individuals also have the choice whether they want to invest directly into a fund and buy shares. However, it will depend on exactly the fund structure, and then maybe we may end up with very local funds, maybe even country-specific funds, and each of those is likely to have probably a minimum investment size. So in a way, it's almost like for the crowd-funded smaller donation, the bond is kind of the easy route in.
Yeah.
Or if they want to essentially benefit from that future dividend of food and energy, and have a hedge against breakdown of the financial system. That's essentially sort of where I was going.
What's the share in this?
Okay, so I'm going to come on to that in a sec. So maybe I'll just hold that thought, and if it's not answered, okay. So what is the money that is being received from donations going towards? So this isn't necessarily an equal proportion. We'll go into that in a moment. But just in terms of the three core things, climate resilient community infrastructure, that's really the key thing. A digital platform that's connecting people and enabling us to get to scale, and climate solutions, so things that can help solve the problem at hand. In terms of the split of funds, so the idea is to have 80% of the money that is received going into physical, real-world infrastructure, which is capable of generating a yield, so generating a return on investment, whereas the remaining 20% is going to things that may not generate a yield. So, for example, I don't know, a very low tech technique to mimic the effect of the Arctic and reflect light back into space would be painting things white. It might sound a bit cartoonish, but actually could have a big impact. That's the kind of thing that's probably not going to generate a return, but could be a climate solution. Similarly, planting trees may be a loss leader if you're not getting any kind of carbon credits. Doing training programs like this, where we're not making money, but it's having a positive investment in the community, in the world, if you like, as well as also building that technology platform, which is designed to be free from private corporate interests, advertising. So it's almost like this 20% is doing the kind of, almost like subsidizing the kind of things we want to be building to create a better world, whereas the 80% is being invested a little bit like you'd think about, investing anything else where you're trying to get a return. Okay, so just sort of how this might fit together. So the idea is that, and effectively, to your point there, anyone really who's buying a bond or creating an account is effectively becoming a member of this community. So somebody buys a bond, that bond is effectively going into the interdependence treasury, and from there being dispersed into these other entities that we are planning to create over time. So the interdependence agency, its mission is effectively, and its mandate is to scale these other things. So Rome wasn't built in a day. We're not planning to do all this tomorrow. This will be a process where these different entities will kick in when we've raised more money. So we're at the beginning of that journey now. But the three core ones, the interdependence network, so the technology platform, the community renewable energy network, and then essentially a climate solutions fund. And then all the other things that we might want to do that might come later. So for example, if you've built a technology platform that is designed for communities, there are all kinds of blockchain-based sort of voting systems these days where you could effectively be using that to create more civic participation than we have today. Those are the kinds of things we might look to explore. So I had a question over there. So.
Yes, don't you think that people buying the bond would like to know, I wouldn't say what I'm buying, but what I'm investing in terms of charitable person. I would like to do something about the environment. I buy the bond because I could, I have a good idea. But what are you going to do with this money? Where? Are you going to build a solar system in the UK or here in England? Because if you have different country playing,
yeah.
How the money is going to be distributed and how the people in different regions and areas and states will have their own say. Because you reach a stage in which people would like to have their own say.
Yeah.
You're not
Yeah, sure.
far away deciding what's going on, what's the
Yeah, and I think that's where this model may well look to. So one of the principles within the interdependence model is the idea of subsidiarity, so making decisions at the most local level possible. It's really a question of scale. I think once you get to a sufficiently large scale, you might have a fund in Italy, one in France, and you might have sub-regional funds, but ultimately what we're trying to do is find a balance between, if you have a lot of support in a particular location and a lot of money coming in, then it's almost like that group probably needs to see tangible benefit first before some people that never heard of it didn't put any money in. Otherwise, it sort of kills the mechanism. So I don't think I've got it in this presentation, but we had a set of criteria, and I think the way we're thinking about this at the moment but we're still finalising the investment principles with the Treasury trustees, is really to be thinking about it in terms of almost like a priority queue. So the place where you have the most money coming in, the most support, the most space, you've ticked all the boxes, would be top of the queue, and you'd be adding to it over time. So you're building up a project pipeline. But what we need to do first, and to do that we need to raise between 2 and 10 million, is to develop some pilot projects. And once we have some pilot projects, we can say, look, this is what we are doing. Now we just need to scale it.
This is what we were discussing yesterday.
Exactly, yeah. And the good news is that there are entities and there are people that are already doing this. And so, yes, it will be good to have our own pilots, but we can also use existing case studies and say, look, this is there are some in London. We're talking to a number of those people. And actually, one of the tasks for the research data analysis working group is to look at those kind of partners and start to, we want to build up that database so that we can have those almost like pipelines ready to plug in as and when we have the money. Okay, so just to kind of give a bit of context as to, as I say, this isn't all going to happen immediately. It's going to take time. So we're already at the point where we've set up the agency, the Treasury. Currently, the network is not built. So we need to raise a little bit more money to do that. The reason that we so once we are issuing these bonds, effectively 50% of all money raised up until the first 10 million will be put aside to develop physical real-world projects, whatever happens. Once we get over 10 million, that will increase to 80%. So there is a slight difference at the beginning, and that's just really because there are other costs involved in scaling up essentially any enterprise, and if we were putting 80% of the money aside, we'd obviously only have 20% to work with, and that doesn't totally make sense in terms of the sequencing. But the idea being that when we begin to develop pilot projects, we don't want to just do one, partly from a sort of portfolio management diversification point of view. If you do one and it fails, project dies, that's not great. So really it's about trying to get to 10 million as quickly as possible so that we can start developing these. And then hopefully with those case studies, we can go a lot faster. We will also be putting some money aside to put into climate solutions pretty much from the get-go as well. And I think that's also partly, obviously because that's important, but also it's a sort of tangible marketing strategy in that being able to say to somebody, when you put this money in, we're immediately doing something good with it, I think helps to make it tangible, helps to make it real. When I say here 10 million plus, that's, there are many things we'd like to do in that area. For example, more programs around, building a network of entrepreneurs focused on solutions, but those kind of things will kick in a bit later. Probably more, 100 million plus. So to begin with, it's most likely going to be working with existing people who are doing good things, and making sure that, obviously there's accountability in terms of knowing what they're doing and what the impact is, but rather than us trying to do everything. To some extent, we are sort of the middle people connecting capital to existing solutions and providing that framework.
Sorry, one question. Is there any goals of time frames?
As fast as possible is the aim.
What is as fast as possible in your eyes? What is
possible? So I guess the way I'm thinking about this is that temperatures are going up at an exponential rate, and therefore we need to be thinking exponentially. So my target, I haven't put pen to paper on this, but it would be a doubling of 10 times every time there's an incremental shift. So for example, if there are 200 people participating in this program, when we kind of really want each person to be bringing in another 10 people so that we're at 2,000, and then the next time it's 20,000, so that you're kind of moving pretty quickly. So not necessarily doubling every quarter or half a year, but going up
in terms of
scale.
so say to get to actually pilot projects happening, to be more specific,
Oh, right. You mean in terms of that development of projects?
When are you looking to have that?
Yeah.
Started? 6 months, 1 year, 2 years, 5 years?
Yeah. Okay. So we aim to be fully up and running with the bond, sort of issuing it by August.
Yeah.
Yeah. And then it's really the question. I mean, it ultimately depends on how quickly do we then start to raise money after that.
Yeah.
This whole thing is driven by that.
Yeah.
But the ideal would be that we're on. I would say that we're kind of in the 2 to 10 million mark within a year, if not less, if we're going quicker. And then within I think that's what I'm saying. It's like if this thing is going to catch fire and go, it needs to be kind of not just doubling, but going up by a factor of 10 at each iteration. Yeah. And the shorter those cycles are, whether it be a quarter or 6 months or a year, the better.
So if it was 10 million in 1 year, it'd be 100 million in 2 years.
Yeah, yeah, exactly. That's. But I think what we need to be doing is shortening that to more like 6 months for the first 10 million. 100 for the next 6 months. Well, we'll see. I mean, there's the amount of money that has gone into what I would consider to be non-useful cryptocurrencies is something crazy, like 3.2 billion or something over the last 3 to 5 years or something, which is about 10 times higher than the amount that's gone into normal venture capital.
Yeah.
So, I don't know. I mean, it's going to be a function of everybody involved in this project and how passionate people are for, and maybe also some of the dynamics at play that aren't in our control, like how quickly people realise that we need to think about climate resilience.
Yeah.
I have 2 points to make. First of all, it could be really spread out, and it could go on us so fast we will have trouble. An example is, as you know, I work with these people on this volunteer force in Mons in Italy. The outcome of the firestorms in Germany and Sweden and the intervention of Polish, Italian, and French fire brigade groups up there end up with a donation of 400,000 euro to this group to build a independent system of intervention. It was totally unexpected. Boom. So it could. The second is, if you're looking about scaling very fast and be productive, I do apologize. I think you need to, my personal perception as a professional, as a student, you should pair up with some university, with some department. As a master student, I'm so surprised about all this. As a master student, I will embrace this project and I will make my summer project your project, and you will have straight result on the table. Plus, you will have free, expertise, not just for the student, but possibly even from the department. And that will put you in a position in front of the regional government, even because there's an article about, I read one of your articles about one of these groups is already involved in the European Parliament for advice, and even you will possibly be granted permission for having grants. Money.
Yeah, well, that's partly what this whole program is. We've reached out to universities all over the world and said to people, "Come and join this program."
Would you do like in a direct way? Go to the universities
and work with them. Yeah,
and because there's always a bit of resilience about it.
I guess it's a question of we have a limited amount of time, limited amount of resources. Where do you put your maximum resources to get the furthest on the chessboard, if you like, or the progress? And I think we've effectively got let's say three targets that we need to hit as quickly as possible. So the first is raising 150,000. That builds us a technology platform, which enables us to grow a lot faster. The next is 2 million. That means we're kind of at the point where we can start thinking about pilot projects seriously. Once we get to 5 million, we can have conversations with institutional investors. So really, it's thinking, how do we raise that money as quickly as possible? And our thinking was, let's crowdsource people to come and help us with that, and to hopefully run an effective crowdfunding campaign that isn't just, you know, a small team, but actually it's maybe 200 people around the world. And I think even just the story of that is interesting.
What you expected someone to buy?
People can put in, you know, 50p if they want.
So let's say £5.
Yeah.
If you have one individual company university in UCL with 30 plus 40,000 students, would you think that perhaps 1% of those people will sign in? Because in between the UCL and Waterstone, there is a Médecins Sans Frontières and all the Mambo Jumbo Red Cross campaigning every single bloody day.
Well, this is our job.
This
Go to UCL and
there we go.
This is for you to do. You've got to go to UCL.
No, but exactly. This is what we are.
You get a meeting with the provost. Sam will come along and we sell some bonds together.
Yeah.
Maybe it's a little early for that, right? But, you know.
let me make sure you guys will know what it is first. That you're,
It's interesting because from the point of view of university, you're always offering a course to your students. This is a course.
Yeah.
This could be seen as an academic issue course.
Yeah, well, that's partly why we,
Because
have sort of explained this as a, you know, almost like a work experience kind of program. It's, you know, it has many dimensions to it, and one of the things we'd like to improve over time is that almost like academy, that program, because it does have a lot of learning, and you would expect students who have the most to lose to be perhaps the biggest supporters, but they don't always have the most money, and they've just spent it all on student fees. So it's, you know, it's how do you mobilise that group of people to raise money within their networks, and that's kind of the strategy. But let's carry on with this, because otherwise we'll lose it. Okay, so governance, just to kind of give you a bit of a sense of how this is all being organised. So the only entity that can issue these bonds is the Treasury, and the only time when they can be issued is when a donation is received. So going back to the kind of crypto world, the idea, you know, having hard-coded set of rules from the outset, so almost outsourcing to, you know, sort of referring to, you know, almost like a godlike figure. It's not quite that, but it's having a set of rules and saying these are the rules, they will be followed, and they, you know, they cannot be changed at a later date. And that will all be recorded on a blockchain, so you have a kind of public ledger that means that, you know, these transactions can be tracked. So the Treasury has been set up as a UK registered not-for-profit, and its sole purpose is to manage that money, nothing else. We are looking at setting it up as a charity, and that might take some time. So in terms of the trustee board, so we are looking to, well, particularly for at least one more woman and potentially two more to join this board at the moment. So if you do know of any interesting people that you think could be a good fit, do let us know. Don't worry about reading all the text, just run through it really quickly. So Philippe Desfossés used to be the CEO of ERAF, which was one of the largest pension funds in France, 30 billion euros under management. He was also vice chair of the Institutional Investors Group on Climate Change. I've been seeing him talk at conferences for many years about climate change, and he's certainly contributing and being very helpful in this project. Ed Gillespie, so he's been in the climate change space for a number of years, angel investor, has written a few books, he's done a tour around the world, not using planes, general great guy. He's going to be doing a talk in the last week, very entertaining, very insightful. Isabelle Delatte, so she used to be the head of investment at Raymond James International. Actually, with my previous business, we launched one of the first carbon momentum funds, so looking at companies in Europe that were lowering their emissions the most. She's been in the sustainable investment world for 20 odd years. Stephen Fitzpatrick, so he's come from a communications background, but also started his career at Greenpeace. So he's kind of been on both sides of the fence, the NGO world, but also the corporate side, and also the world of finance. Certainly gives him an interesting perspective. And then Pierre Lender, so he's going to be talking more about the bond and generally doing a sort of 101 on finance. It should be interesting in a couple of weeks. He's worked across the investment world and is also an impact investor, and in more recent years ran essentially a startup that was looking at sustainability in finance. And he's definitely been sort of leading almost like the working group on this bond over the last few months. So in terms of the bond itself, as I mentioned earlier, it's really a digital receipt for a donation, and that digital receipt could be viewed as a certificate or a contract, which is then detailing those rights. And so we're in the process of finalising those at the moment, but it's a little bit like, as with a pound note, I promise to pay the bearer on demand the sum of X. It's like same kind of idea. So what will it say? Well, first of all, that there are certain elements that cannot be changed, like the issuance mechanism. So the idea that it's only when a donation comes in that a bond is issued, and also how they're being valued. So when we go live with it and launch it, that valuation formula will be fixed, will be predetermined. It'll also say that you can transfer it to other people, and that it will be redeemable, hopefully by other entities eventually, but at least to begin with, not right away because we have to build the infrastructure, but in exchange for food or energy produced by that network.
It's like an investment, you would say. It's kind of like an investment.
Yeah, as I was saying earlier, it's like a hybrid between an investment and a donation. I mean, it depends what your definition of an investment is. People invest time in things, in energy.
Donation, then it would be a one-time thing and then it's done. Forget about it. That's the donation.
But that's why there's an 80-20. So 20% is not considered an investment. It's not a yield-producing allocation of funds. It's just going towards something that has a return that is non-financial. So like sustainable future.
I'm going to cover it in a second with a couple of points. So it's not a security, and a security typically means that you have voting rights, so being able to have influence over the management. It means that you can take your capital out, so a redemption, and it not always, but it often means that you get a dividend, so like an interest almost, and that is not the case with this. And the technical term for it, that wasn't the right slide for that, but okay, I'll just finish this one. So money comes in, bond goes out, but you can't take your money back out in fiat, just to make that crystal clear. And that, in the language of the Financial Conduct Authority, the regulator in the UK, it is a utility token. So effectively it's a token that you can use within a closed community at this point, which is just within our network, in exchange for something that we are effectively building with that money that we received. So that's if you're sort of pushed on the technical term, it's a utility token and definitely not a security. And that has meant that we have avoided going down, part of the design here is to avoid going down the regulatory route, because that costs time and money, which we don't really have to be spending on that right now. And it fits with the design of what we're ultimately trying to do. If everybody could take their money out, then that would slightly mess up the whole building infrastructure for the community, to say the least. Okay, so how does it work in a little bit more detail? So Treasury receives funds from donations. 20% of that is going into things that may not generate any yield. The remaining 80% is going into an infrastructure fund of funds. So you have so a fund of funds is effectively a fund that might invest in multiple funds. If you think about almost like a cascading waterfall. So I mentioned before, we might have regional ones, national ones. Often it makes sense as well to create individual legal entities for specific projects. And those funds would be investing in line with the investment principles. And I should say as well, always within the mandate, so it's not going to be investing in oil and gas or fracking. It has to be, climate resilient infrastructure, as we've mentioned. So we have although it's likely to come a lot later, we have included climate resilient housing in there as well, as local food production and renewable energy. So at a later stage, it might be that we're actually developing physical communities. So that means, with that 80%, that the interdependence treasury is accumulating shares, just like institutional investors, within these funds. which it is then holding and managing on behalf of the community, and it is the value of those shares that is backing the value of the bond. So, and one of the reasons for doing that is that if you're investing in a fund, then it's a regulated entity. Typically, most funds are required to publish their net asset value, or the NAV, and that's effectively how, in a transparent and fair way, we can actually say, well, this is what the value of the bond is, rather than us just saying, oh yeah, it's 100 million. Actually having a regulated entity do that. So Brett earlier was talking about how it is typically government that subsidises almost like the good things that should happen, and that's often where a lot of innovation comes from. Unfortunately, they've just killed all the subsidies for things like solar in the UK, which is just ridiculous. But anyway, unfortunately, in certain contexts, depending on what the project is, sometimes you do need to subsidise things. And so what this project in some ways is about is saying, well, because we're receiving donations from the crowd, and because we know that we need to do this, we may well subsidise projects to begin with to get them off the ground. So the investment principles are effectively saying it has to be economically viable long term. It can't be loss leading and mean that the fund decreases in value. But if there is some capital that needs to be put up initially to get it going, and it otherwise wouldn't happen, then we will effectively do that. And so what this chart here is saying is, to begin with, we expect that, especially as we're smaller and we're less well known, so once you get to more economies of scale, it will be a lot easier to basically make everything happen, to get cheaper contracts from suppliers, the equipment, everything. It's possible that we might need to subsidise more in terms of the effectively the amount of money that the Treasury is almost like donating to start a project. And what that means is that at the beginning, and it may well be that it's actually higher than this, but the minimum participation rate would be 50%. Yeah, effectively what we're saying is that the amount of money that will be subsidising could be up to 50%, and then over time that gap would close so that you're subsidising less and less. I mean, it's kind of the same logic as the feed-in tariff, where the government has sort of said, oh well, we don't need to subsidise it anymore because it's cost competitive. I think they've done that too early, and you could argue that we're almost trying to fill that gap. But what that potentially means is that the amount of shares that the Treasury is owning to begin with may be lower, but over time it will be getting more effectively for its money, if that makes sense. So ultimately what that means is that the bonds or the certificates, their aggregated value, so all of them, they're all pari passu in the sense that whatever point in time you buy a bond, they will always be worth the same, the different bonds. And so as that participation rate increases over time, and effectively the Treasury has to subsidise less and less, you would expect the value to go up. And so the way we've essentially designed this is to say that if somebody is coming in earlier and donating earlier, and there is less shares backing their bonds, then they will benefit from the value going up over time as more money comes in. So that essentially it's fair for those people, but also not to the point where the new investors or the new donors are subsidising, or not necessarily subsidising, but giving so much money to those that came in earlier, if that makes sense. But the point being that at any point in time, the value of the, so in short, ID bond will be derived from the aggregate value of the shares in all of these various funds that will have been accumulated, divided by the total number of bonds issued so far. So that's how you'd get the value of one bond, and that will always be published on the interdependence network. so that people can actually see, what is the price. Within the world of infrastructure, you're not revaluing assets more than probably once a year. So it might be that there's a periodic change in the net asset value, but it should be relatively stable in the meantime. Did you have a question there? No?
Could I ask?
Yeah,
Sorry,
sure.
I'm a little bit lost, just a little bit. Not your fault. It's just me, maybe just being a bit thick. But this. So just to pull it back quite a way. Are we saying that the interdependence agency is going to be setting up asset funds and buying a stake in those same funds, or buying a stake in other pre-existing funds which are investing in renewable assets?
Good question. So one of the key, investment principles here is that we're looking to create new infrastructure, new capacity, new supply, if you like, rather than buy existing things.
Okay.
That's the kind of core principle. It's sort of the idea of almost additionality. And this, by the way, it's the interdependence treasury that would be doing that rather than the agency. Sort of trying to separate almost the financial custodian element from some of the other things. And the way it would work is that so it's quite costly to set up a fund. There's legal costs, there's startup costs, all the rest of it. And also you've got to get regulated. So what we would look to do is work with entities that already do that specialise in that area.
The institutional investors, basically.
Yeah, exactly, or asset managers primarily. Whereas, so if, let's say we've got 5 million that we've raised, we almost become the client, where we're seeding, effectively we're seeding a fund. We're saying, look, whoever it is, BlackRock, Allianz, you do this for a living, you have lots of clients that might be interested in this. We've got £5 million, and actually, well, let's say it's 10 million, but because of the way we've structured it, we're actually going to be subsidising 2 million of that 10. So we're kind of making it a little bit more attractive to get it off the ground to begin with, and then we can almost crowdfund in money from other institutional investors, and then everyone is investing on the same terms.
Sorry, and the point about the subsidy, what was that? So
Okay.
we're subsidising 2 million of the first 10. So what do you mean we're paying the asset manager? No.
So we're not paying the asset manager. What we're looking to, so this might not be required. We might find that we're it's easier than we think. But what we're expecting, having spoken to, for example, there's an entity in London that has scaled many projects now in the renewable space, and it sounds like from the data that they have, they've often had to subsidise an amount to get it off the ground, and that has historically come from local government or the government originally. However, once you get to a certain scale, there are that subsidy amount goes down. So, but there's effectively the issue we have at the moment is that for certain projects there needs to be some subsidy, some free money to kickstart it and get it off the ground to kind of bring in all the other people. It's pretty much what Brett was saying earlier, where so we could spend the next 10 years. In fact, it's what I've been trying to do for the last 10 years, trying to convince the investment world to recalibrate their thinking. Or we can to some extent almost replace the role of government here by crowdfunding to subsidise some, not all, but just enough to make it work, to then crowd in the money from institutional investors.
Right.
That's kind of the logic. But what we expect is that, and this is what this graph is trying to show, is that over time we think that will be less and less applicable and required. And that's really a function, I mean, it could just as well say scale along the bottom rather than time.
Right. But sorry, who's receiving the subsidy? Is it the people doing the projects?
It's more to pay. So I wouldn't say anyone's receiving it. It's more to pay for the costs, typically the first elements of the project, like the development cost of certain components of it.
Okay.
It's really
that they might not be economically viable. Like if you look at it coldly from the outside to begin with, it might not be that they look economically viable. So the subsidy, in a sense, is us saying we'll fund it despite that.
Yeah. I think what I'm confused about is how this is linking with the asset fund that you were talking about earlier. So are these two separate points we're making?
So when we say participation rate, what we mean is the so if 100% participation rate would effectively mean that if we're putting in £100, we're getting £100 worth of shares.
Okay.
If we're only getting a 50% participation rate, it means we're only getting £50 worth of shares. So effectively, you've got £50 of free capital subsidy, if you like.
I think I get you now. Sure.
Okay, so just to make this point quickly then, so co-investment from institutional investors, this really is where the game is at. And that's partly why I've sought to put people on the trustee board that have backgrounds and experience in the institutional space, because that's how we'll get to escape velocity, hopefully. And so effectively the way it would work is that you've got the shares held by the Interdependence Treasury, though that's funded by donations, and then shares held by institutional investors, potentially high net worth individuals, or however it's structured. It might be that the fund structure does enable people to participate from, £100. We just don't know until we've created it.
So I do have a question. I might be ignorant or so, I'm not very clever. The word shares, it's a linguistic thing. I only understand shares in terms of buying it from a floated company. I don't understand what you mean by shares.
Yeah, so a floated company, or any private, any company that is limited by shares, right, will have shares. So the Interdependence Agency is limited by guarantee, which means there are no shares.
Okay.
And any company can, basically create as many shares as it wants, and they will all have a price typically attached to them. So in the case of a fund can be thought about as almost like a company with shares in it.
Yeah.
And then it might be that, so an investment vehicle, like the simplest one that I'm familiar with, which actually we sort of borrowed some of the ideas from, it's called a unit trust. So it's almost like the word share gets replaced by units.
Yeah.
So let's say that you've got £100 goes in, each unit is £1, so there's 100 units, and then it has a specific purpose. So maybe the purpose is invest in clean tech.
Yeah.
And so, if you've put 20 quid in, you've got 20 units, it's a bit like 20 shares.
Yeah.
And that's kind of it, really. So
okay, so it's the same idea. So okay.
Yeah, it's and even so, a company that, so let's say something like Facebook, that got floated on the stock market in what's called an IPO, or an initial public offering, and so they went from being privately held shares to floating on the stock market, which means anyone can buy and sell them.
Oh, I see. So it's the difference between whether you're in control of who can buy them and sell them, or whether it's just anyone can do it and it's on an exchange.
Pretty much, yeah. It's kind of like
right.
it's sort of like, where is the market public or private?
Yeah. Okay.
And one of the main, so Brett mentioned this earlier, one of the main reasons for listing, for being listed on the stock market or floating on the stock market, is that it's easier to get capital, to raise capital, because it's a liquid market. Whereas, if you've got a private company, it's not always that easy to sell your shares.
No, yeah, okay.
Okay, so last bit then, right? So we started off by talking kind of quite conceptually about money and what money is and does it serve us. So can I sort of ask a few questions? What is it that makes, what characteristics make a currency viable? Well, there's this idea: is it inflationary or deflationary? Maybe confusing terms, but basically, is it going up in value or is it going down? That's I think an interesting question. Does a central authority, where you have no control, have the ability to devalue it? So you might hear, for example, in the the news talking about often it's China that's referred to, that they're sort of able to devalue their currency. Might have noticed that the pound was devalued recently. So that's actually, if you're trying to sell stuff abroad, that's actually really helpful. If that's what you're doing. If you're like probably us, and you have to, if you go on holiday and you suddenly find you're 20% poorer, that's not so great. But the key thing is who has the ability to do that? I mean, sometimes it might be out of your control. Is it accepted as legal tender? So legal tender, essentially what you can pay your taxes in. It's almost like the official currency of a place. Is it asset backed? And then, how many people are there where you can actually exchange it, which is the sort of thing we were just talking about with listing on the stock market. And how big is that marketplace in which you can exchange it? So, if you think about the UK, it's like the pounds can be exchanged everywhere in the UK, but actually you can exchange them pretty much anywhere, really. Not so useful if you're, on the other side of the world in a small cafe, though. Something that maybe doesn't always get thought about, but what is the brand value? What does it actually represent? What are the values behind the money? So essentially, I kind of did it. I haven't actually filled it in here because it would be too small to read. But just thinking about, okay, well, if we're doing a comparison between fiat money and what we're proposing, and I'm not saying this in the sense of it's going to become a currency tomorrow, because it won't. But as a sort of long-run vision almost, it's just a bit of a thought experiment. So what does it stand for? Well, interdependence bond is about building a better future. Fiat money, I guess I'll let you think about that. But number of people with whom it can be used as a medium of exchange. So for the interdependence bond, this is very much going to be a function of the number of people that effectively join that community, join that platform, and believe in that project and mission. Which kind of goes back to your question earlier of how long is this going to take? It's ultimately going to be a function of people. How many people decide that they want to support this or not? And what strategies and skill can we use to make that go faster? So the size of the marketplace in which it can be exchanged. So this is, you might have seen that one of the, in the How We Work document, and we talked about it briefly the other day, but one of the projects for the network is to curate a sustainable marketplace. And part of the reason for doing that is because currency, or money, or whatever you want to call it, derives value from the size of the marketplace in which it can be spent. So although it's not a near-term objective, our longer-term objective is to have other vendors accept this as a medium of exchange. So is it accepted as legal tender? Well, we're not going to become the government anytime soon, so we're not going to be able to enable people to pay their taxes with it. But certainly within the ecosystem, within that community, it is going to become, or is going to be the official currency of that interdependence community. So to some extent, within that ecosystem, it is the legal tender. Is it asset linked? Well, this is one thing that we definitely have over fiat money, which would be that yes, it is, because it's backed by that basket of assets, whereas fiat money isn't. Does a central authority have the ability to devalue it? No, in the case of interdependence bonds. However, with real money, I'm afraid that it can be devalued, and it is seemingly continuously devalued by governments. Is it inflationary or deflationary? Is it likely to go up in value or down? Well, the latest data on certainly renewable energy, solar, suggests that you can be generating anywhere between a 3 and 10% yield per year. Obviously, in this case, because we're also funding climate solutions, which isn't designed to make any money, there is always going to be a little bit less of the yield shared out. But we certainly think that this can achieve that trend of a gentle increase over time rather than going down in value, which is the opposite for fiat money. Okay, and that's pretty much it. I had one slide on carbon accounting because I slightly forgot this. I was supposed to add a bit of that in there. Yeah, I know. Does anyone want to ask anything before we close on that briefly? Sam, do you want to go first?
Yeah. Is there like a certain percentage of the total yield from the assets owned that's going back towards the bondholders? And what's that percentage? And then is it relative to how many bonds or what size of bond they?
So technically, there is none of the yield none of the cash is going back to the bondholders. It's effectively being reinvested back in the community along the lines we've described. However, if there is a yield, then effectively the value of an individual bond relative to existing currency, like pounds or dollars, should go up. So it's more in those terms, that you'll experience the benefit. So it's really an asset that should increase in value over time.
But you can't sell it.
So I mean, you can sell it. What we are avoiding for certainly the first 6 months to a year until we've raised enough money is becoming an exchange where you can trade it on our platform, but you can still transact it with other people. I mean, that, if anyone's particularly interested in that, that could be an interesting working group to think about. How do we want to go about doing that? Because I mean, you're right. I guess what we're kind of betting on to some extent is that the first people to support this, those kind of 2.5%, the innovators, are going to do this more because they think it's going to go up in value and they want to support it, rather than that they instantly want to sell it. Especially as for the very first adopters, where the participation rate is lower, we're having to subsidise more, the technical value at that point in time is likely to be lower, and the return will come a bit further down the track.
Yeah. 80 to 20%. There's nothing left for administration.
In the 20%.
Yeah, it's in the 20%.
But don't you need to be more clear and defined on that?
Yeah, I mean this.
That could just be.
Oh yeah, sure.
If people wanted to be accusatory, they could say, okay, so 20% just goes into yield activities, and the administration's in.
Well, this is partly why we're looking to create it as a charity. Because if you're a charity, you're legally required to publish all your an annual report.
Right.
And obviously, there's a kind of. I think that's the kind of thing that we would put in the contract, if you like, so that it's up. So to have a cap on it.
You don't want anybody to be able to say, "Oh, I don't want to buy because."
Yeah, absolutely. It's a completely fair point. I guess the point I'm trying to make is that you wouldn't want it to be too high because it would damage the credibility of the whole thing. And so if we're having a transparent reporting process anyway, it almost keeps it in check. That's part of the sort of logic behind.
What do you guys expect it to be at? 5%? 10%?
No, nothing like that. So I think that the venture capital world, which is sort of the most comparable, it'd be something like 1.5% to 2%. I think that's the kind of cap. So we'd probably look to kind of go in line with industry standard or lower.
Yeah. Yeah. And then the other question was, I think I'm still, even after all this, a little bit confused. A little bit. Is the Interdependence Agency, or no, the Treasury, I think, interdependence, are they making projects and saying, okay, we're going to make this project and this is going to happen, or are you funding projects? It's just fun. So people would come to you with a project and pitch to try and get some of that money.
Let me just go back to this.
So then,
directed by the community. That's the point of having a network. So it's like there are concentrations of people and donations and demand in a given area. That's where the funds go.
I think the reality is that what we're trying to design, and it's very much an evolving process, is something that is flexible enough to deal with different situations, which are going to kind of depend on the local environment and many factors that we can't determine now. So I guess what we see the role of the Interdependence Agency and these different bodies over time is helping to scale, like to provide almost like the framework, the organising tools, the help to kind of empower local people to hopefully run with it and own it, but also bringing in people that actually know how to install solar panels. But then it might be that you train local people to maintain them or whatever it might be.
Okay, so that leads me on to my next question then. So what amount, because they're obviously then bound to whatever the yield of their project is, to if it's not owned by interdependence, agency, treasury or whatever, if it's just their project that you've given money for them to do, but then they, what's their commitment back to interdependence in terms of what they have to then, what they're obliged for, essentially?
Sure, that's a good question. So I think ultimately these things will be governed by a contract.
Yeah.
And so for so long as we have contracts and the rule of law, it's just like any other transaction in a anonymous economy that we have.
But so what would be in the contract? That's my question. Is like how much do they own it, and how much do they have to then, when someone comes with an interdependence bond, they just have to sell it for free?
So the kind of the way, and again, will be sort of refined over time, but it's the kind of idea that it might be something like you have to sell 50% of what you're producing over and above what you need, or however it's structured. So it's most likely going to be that the needs of the community are met, and the surplus or some percentage is then distributed amongst the wider network.
So how does that fit into? Sorry, it's just my brain trying to piece all this together. So how does that then? Because if you don't own the stuff, like the project or the stuff, how does how do you get the NAV?
So the fund
does own everything. That's the point of it. It's owned through this.
So it's the community to themselves, but then it's
okay. So if we go,
so interdependence agency gives a loan but takes a share of the ownership of the project.
So all the assets that are created contribute to the net asset value of the whole, and in essence, everybody who has the bond is a shareholder in the total, rather than just their specific local project.
Although, that also depends. So that it might be. So this is like this slide here is a simplified version, and your question is kind of getting to the heart of it. So you could, for example, have at the top local fund A, I don't know, Bristol fund, and it's the donations that have come from everyone. It's some institutional investors. Maybe it's also there's a box here for local community who bought shares directly. Yeah. And they might just want to invest in their fund, or they might want to invest in the whole. It kind of, the idea is to provide almost as many options as you can, but the donations part would be always sort of funding like all of the different projects, if you like. Okay. It's almost like, and that has to happen in order for it to be an interdependence fund, even if we only have 5% or 1%, whatever it is. It's almost like we're sort of saying these are the investment principles, which broadly speaking should be the same across, at least within it might be that there's a different economy and you need to have a slightly more flexible setup in a different place.
So just one more, can I just finish this one train of thought? Because I just want to get it really clear. Because if someone asks me what I've been coming to,
absolutely.
What is it? I don't want to be like, I don't know. What's the incentive then for someone to pitch? Say you are in Bristol, you have a community project you want to do. You could come to Independence and you could, sell off some shares, and then also not only have you sold the shares to get the money, then what you can sell is got to go at zero. You have to sell some of it because someone will come and redeem a bond.
Which shares are you talking about selling?
Well, okay, so not shares. Sorry, I've got the language wrong again. Okay, let me simplify the question. What's the incentive of someone coming to interdependence as opposed to just trying to get donations from their local community and fund the project themselves?
Yeah, so everyone is welcome to do that, and they can do that, and they probably are already doing that. In fact, there are lots of community projects. What we're trying to do is build a global movement to get to scale, and our thesis is that we can do this faster by pooling our resources and effectively getting better purchasing power, better contracts, building up more knowledge so that we can go faster.
So their incentive is you'll get support, you'll get cheap prices for what you want to buy to do the project, you'll get money quicker, possibly more money.
Access to people in your area who are like-minded, who perhaps
Surely
also being sold on
Okay.
the...
Well, this is partly where the technology platform comes in. So its main
And
purpose
access to-
is to
yeah,
connect
the-
people.
So the community part of it is like building community.
Yeah.
So maybe we should run through an example. Is that possible? Could we do like a hypothetical? So I don't know if this is a good example, but say me and my brother wanted to build a solar panel in our backyard or something like that. Is that too
Yeah.
small scale?
So,
Or what's
so-
the journey?
Sure. Okay. So let's say that. So where I was living, I just moved house, but where I was living before, it was like a row of terraced houses, and you had big gardens. So I think it would be you kind of need to start with like at least one person who's up for it, and then it would be a question of, all right, let's try and get some support from the local area and start kind of the ball rolling. I guess the steps are you're looking for support from the community, so that you're trying to really get to a kind of critical mass of locations that you can develop infrastructure in. I mean, if we're talking about solar, it's roof space, ideally south-facing. And the economies of scale and the kind of, just the economics of it, kind of mean that you want, ideally, probably not going to be possible to begin with, but 200 almost houses within a relatively close-knit area. So that could be a sort of a block in London. And then, so let's say you've got the support, you've got the space. It's then really about fundraising. So if that community has raised more money than another community, we're going to kind of prioritise that one. I think that's how we're thinking about it at the moment, but it's not set in stone, and it might need to be more dynamic to make sure that we're not, discounting places that are less affluent. So it's trying to find that balance. But yeah, so let's say then you've raised enough money, then it's probably more about planning permission and actually starting to scope out the project, deploying the capital to actually install the infrastructure, and then beyond that it would be more about, and this is partly where the technology platform comes in terms of things like time banking and having the kind of resources to effectively organise, even things like voting, having online, like how are we going to manage the gardens, how are we going to manage these solar panels. So trying to sort of enable all of those things, and as this initiative scales, it's like having more resources to train people in that or help them develop that locally. So it's almost like when I originally was thinking about some of the stuff, that sort of the idea of like an agency that goes and empowers people to become agents of change, action, to get to scale.
Yeah. Could I think a bit like an analogy like the Arts Council? You have a good idea, go to the Arts Council, they give you money. And support.
It's similar, yeah. I guess it's
like if I wanted to boil it down, like elevator pitch.
It's
kind of a bit like that.
It's a bit like that. I would say it's a bit more structured though, because we're not just saying any idea. We're saying, do you want to develop local renewable energy or sustainable food production in your area? If you do, come and talk to us, and we'll help you make it happen.
Yeah. Okay.
Yeah.
Okay. Cool.
And it'll be a two-way thing. Like people on the ground are trying to help make that happen, and we're kind of supporting them. Yeah. That's sort of the role of the entity.
And their obligation will be then at some point, people will come with these bonds. And will the bonds be ring fenced to areas? So I couldn't necessarily, if I had loads of bonds and I went to Scotland and then said, okay, well, your local community did something really good. I'm going around the country finding all the best projects and then just buying all the best stuff with my bonds. Will the bonds be ring fenced around different areas, maybe? So
at the moment, the idea is for it to be more like like the euro, that you can exchange it digitally through a technology platform anywhere. Yeah, rather than, but you could go in that direction. You could go more in the local currency route, but that's not really what we're proposing.
Yeah, it sounds like
might be worried about okay, I'm going to do this for my local community, and then someone from 50 miles away is just going to come with their interdependence bond, or they've got so many interdependence bonds that they could actually buy most of my yield and take it out of the area.
Yeah, so you
take most of the energy and
I think that's part of the. If you think about it as well, there's always going to be a dynamic negotiation between, almost like this outside entity that is trying to work with a local community, and you need to cooperate. Yeah. So you're not going to have a deal, if you like, that screws them over to the point where everything they are growing and producing is shipped out, because they'll just, probably won't support the project.
Well, so that's what I'm asking is, what's the processes in place to stop that happening, essentially?
Yeah, so I think it's going to be a little bit of feeling that out and testing it, and because this is kind of a new thing.
Yeah.
But ultimately, the framework is to find something that is. It's almost like we have a bunch of variables that we're trying to solve for and balance out. So one is, we want the outside kind of world to put enough money in to make this go fast, but we also have to balance the needs and interests of the local community.
Yeah.
And so I think, things like saying that you've got an amount of whatever's being produced, whether it be energy or food, that is sort of ring-fenced for the community to feed them and water them, essentially, or power them. And then it's maybe the surplus that is what's sort of sold on the wider network.
Yeah. Okay.
If we're out like selling these bonds to people, and say we find like Mrs. X, and Mrs. X is wealthy and fairly experienced with trading, and has realised that the value of renewable assets is going to go up and up, and it's going to be cheaper and cheaper to read things like energy from renewable technology. So she wants to make gains from that. What's the interdependence agency offering her with an interbond, which is better than her ability to just go to a wind company or a new solar farm and buy a stake?
I think it's quite a different proposition. So there's sort of, the way I guess we've sort of been thinking about it is almost like hard-nosed investors. So if this person is so wealthy that they consider themselves a high net worth or sophisticated investor, then they're almost in this kind of category on the right-hand side, and they might just want to buy shares, sort of traditional, conventional shares in effectively a fund. So we are almost another one of those funds. The only difference is that our model is to try to aggregate a diversified portfolio of local infrastructure, whereas most of those other ones that exist are often bigger projects. Not to say that there aren't some smaller ones, but you can't get exposure to a massive portfolio of smaller ones.
So it's like, for me, jog blogs, like I'm sort of interested in, maybe I'd like flick around on eToro or whatever, but I don't really know what I'm doing. This is providing me an opportunity to get essentially a stake in 30 renewable businesses for just like 100 quid or something, just in out of the desire to be involved in something.
Yeah, I guess it's the part about the token is also almost thinking, and we're going to talk a bit, I guess it's sort of thinking ahead of, what do we want the future of money to be? Would we like it to be something that actually does good? And so actually you're kind of investing almost like in that vision as well as the financial side. So it's almost like this is almost trying to find a way to balance between getting everyone to invest in the vision, but in potentially different ways. So I think it's just different ways of thinking about it. So Mrs. X might really understand the climate crisis and think, actually, having something that's really kind of a hedge in my portfolio that means I potentially can access food and energy if the system goes down, that's kind of interesting. I'll put 10% into that, but actually I'm pretty conservative and I'm going to put 90% into what I'm used to, for example. Yeah. How's everyone feeling? Because we could do the carbon thing tomorrow if everyone's a bit it's quite a short one.
I can keep going.
We've got a question.
Yeah. All right. Should we just take a little break? Yeah. All right. Cool.
And those people, people are going to buy the bonds. For example, I think in rent, and so in my community is going to be 5 projects, different projects, solar and all this. Do I have a say? I invested, I bought the bond. Do I have a say in which project will I like to redeem when I just invest, or it's?
When you say redeem, what do you mean?
For example, like solar energy or the other. There is the outcome of the other project.
Yeah. So I think that this is the sort of point I was trying to make with this, where if let me just get back to that. the fund structure will enable more what's the word? Sort of division or like specific funds. So you might have, you know, a Brent local fund, and it might be to develop, I don't know, renewable energy, or it might be a food thing. And so if you wanted to buy shares in that, then yes. At the moment, though, the bond is more of almost like a global donation.
Yeah. When it gets like I will get like special outcome, like energy, like when it gets like I will get energy for what I invested, like in the price at the time.
It's more like the yeah. I mean, so this is the kind of thing that is like a bit further down the track. So I wouldn't say I can give a definitive answer on this, but I guess it's kind of going down the same route as. So once you have so energy, I mean, energy is almost simpler than food to transmit across a network. So once electricity goes into the grid, it's basically all the same. So I'm using it's good energy at the moment. It's renewable, but the specific it doesn't mean it's next to my house. It's just part of that grid. Yeah. So in terms of maybe the food is a sort of better example. It's almost like there would be physical locations where you would be able to go and redeem that. I mean, these are some of the sort of, say, the details where we're still refining it, because it's trying to find this balance in that tension between making sure that the local person is sort of seeing something near them, but at the same time, it's like, you know, how do you sort of solve a global problem?
Because what I thought it was, which I think it is in the long run. For example, if you had again, you have a solar farm or whatever, and at the price at that time, like the kilowatts per hour, the I don't know how many. But if I invested, I don't know, like £50 in the token shares, would I have like that redeemed in terms of energy? Like, I don't know how to explain myself.
So the idea is that there would be a price per kilowatt hour. So let's say it's, I don't know, £1, and the bond, let's say, is worth £1. So one bond would get you 1 kilowatt hour, just in simple terms. And that would be like, it might be that that's the price in a specific grid, like the UK, and then maybe in Spain it's like, I don't know, 50p or something. It's sort of you know, you're going to have local market kind of dynamics. So that's almost like just how it is already, and we're not interfering with that. I'm just going to take a short break for a second. Alright, so carbon accounting. So I think it's kind of a little bit of change of scene actually from the last bit. But when we're talking about climate change, climate impacts, it's kind of helpful to actually know what we're on about. Brett in the last session mentioned sometimes issues with projects where it turns out actually they're not really doing the thing that we all thought they were supposed to be doing. And so it's really important that we're quantifying things in the right way. And within the world of carbon accounting, if you're wanting to understand effectively the emissions, carbon accounting is a way of saying understanding the emissions of, in this case, corporates, companies, but it could be applicable to pretty much anywhere. And if you think about a country like the UK, I think Greta Thunberg called us out on this recently. I say they us, I mean the amazing government we have. Our emissions look like they've been going down, but actually we've been outsourcing them to China or wherever else it might be. And within accounting for carbon emissions, there is this idea of these three scopes. So scope 1, scope 2, scope 3. So if we start in the middle, this is a diagram of essentially you've got your company in the middle, your reporting company, your upstream activities, which is to the left, which is everything that's effectively happening before you get to the company, and then there's whatever you do in the company, and then the downstream activity, so everything sort of once the product has gone out of the door. And then you can see in the background you've got Scope 2 emissions, which is essentially your energy consumption. Now if you think about, and then at the top we've got the greenhouse gases that essentially, seven. So there's a Kyoto basket of 7. These are the main ones that effectively were legislated for under the Kyoto Agreement. They're the ones that are causing the problem. And they all get converted back to CO2 equivalent because that's the most common one. But things like methane, CH4, is quite considerably more potent than carbon, which is worrying because they're going up a lot. Okay, so just to kind of go through this conceptually and then maybe a bit more detail, if you think about every time you hit the light switch at home, typically, unless you've got a wind turbine on your roof or solar panels, that energy is being generated somewhere else. And then it really depends what is the source of that energy. Is it a coal-fired power plant or is it a wind turbine? And so that purchased electricity, so it's emissions where you're not producing them directly yourself, but ultimately your use of that energy is contributing to it. So this is why they're called indirect emissions. Scope 1 here is effectively the things where you or the company has direct control. So if you've got an industrial process and it's emitting tons of carbon, or as per the example, you've got vehicles that your company owns, it gets a bit more complicated, and this is where Scope 3 comes in. So that's effectively I like to think about it as the supply chain, although I think the correct term is value chain. But anyway, so you might have, for example, a company like Uber, which doesn't actually, I believe, own its vehicles. It's the individual driver, but obviously, the business is basically taxis. So you'd think about that in the Scope 3 camp. And unfortunately, and this is kind of what a lot of the sort of advocacy work we did or have been doing at Engaged Tracking, my previous business, was really about sort of shouting from the rooftops that Scope 3 is very important. And we've been considering it for a very long time and trying to educate people on that, because it's typically where 85% or more of the greenhouse gas emissions come from is in the supply chain rather than the company. So if you think about, so Brett had a great example earlier, a company like Apple. Apple actually doesn't do a lot of the manufacturing, the mining, all of that stuff. It's almost like a marketing company. Okay, they probably do a bit of software as well and some nice designs. But the vast majority of the emissions with a company like that is going to be in its supply chain. And then you think about a company like ExxonMobil, who are a massive oil company, oil major. Actually taking fossil fuels out of the ground may not. I mean, they've been getting more and more efficient at doing things like that. That might not be where the emissions are really occurring. It's actually when you or I or whoever else, hopefully we're all cycling, might drive a car around or get in a plane. It's when those fossil fuels are combusted that you really see the impact. And so in the right-hand side, you'll see number 10, number 11, use of sold products. So if you're a fossil fuel company, that really is where all of your emissions are. And so one of the main things that we as an organisation have been doing over the last 10 years, Engaged Tracking and previously not-for-profit, is really saying, if you're going to be thinking about this, and particularly if you're going to be allocating capital, if you're not taking that into account, then actually are you just potentially supporting the wrong companies? You're not actually redirecting money from the high emitters to the low emitters if you've got your accounting wrong in the first place. And unfortunately, there have been various so-called low-carbon indexes that have even included people like ExxonMobil and said, oh, these guys they're a leader. which is quite frankly ridiculous. So if you see, just do check what you're looking for. Unfortunately, not everyone is always thinking about this in such detail, and yeah, so just because something is labelled low carbon, do check. So yeah, I think that's the main point. I'll just perhaps end on, Andrew asked me earlier what we used to be doing, or still are, at Engaged Tracking, and so the core concept essentially was to be ranking companies according to their greenhouse gas emissions, their scope 1, 2 and 3 emissions, and we would divide that number by their revenue figure so that you have an intensity. So how many tons of carbon are being produced per $1 million of revenue? And you could use different metrics, but that's kind of the most widely used. And what that enables you to do is compare companies of different sizes. You could, however, decide that actually you wanted to just rank companies on absolute emissions, because ultimately the ones creating the most emissions are the main problem. But you, by and large, even when you do it by intensity, you still find that oil, gas, mining, extractive industries are at the bottom, and it tends to be sort of service companies, technology that are sort of at the top, lower carbon businesses. And so we'd create a ranking. That meant that we had a lot of data, then provide that to investors, and then also use that information and the expertise we had in the team to come up with analytics to try and inform people about, or I say people, predominantly institutional investors, about how to manage their carbon risk, and to really make the argument, to try to make the argument that investing in high carbon companies is not only bad for everybody, but potentially a terrible investment as well, particularly if we see some sort of carbon shock, where perhaps everybody suddenly realises we're going to have to decarbonise and shift away to a new economy, or, as James mentioned the other day, if actually it's new technologies. It's nothing about carbon pricing or even sort of shifts in behaviour. It might just be that the new technology is better than the old technology. And so if you're a pension fund holding the old technology, the the blockbuster video that got replaced by Netflix, or the I think it's Kodak. They didn't sort of make the shift to digital. If you look at history, we've had all kinds of companies. I think it's something like some number. It's like the average, the sort of turnover of new companies on the stock market in America. It's very high. There are very few companies that have been around for more than 10, 20 years that are sitting there at the moment. And certainly if you looked over 100 years. So it's really, I guess, the question of where is the future headed? Is it a low carbon future, or is it a high carbon future? And where are you invested? So yeah, that's basically it really from the carbon side. Does anyone have any questions you want to ask about that?
I don't recognise every single one of the compounds.
Yes. Let me see. Oh yeah, that's on my other one.
Methane, nitrogen.
There we go. I think we've got them all. Yeah, there's if you look in the campaigns guide, there is a table where they're all written down, and you can see the. Is it in the campaigns guide? Yeah, I think so. You can see the global warming potential expressed in CO2 equivalent over 20 years and 100 years.
On the bottom of the fluorides.
On the what, sorry? Alright, well, if there are no further questions, then we'll perhaps wrap it up. Alright, thanks very much, everyone. Cheers.